Thank you, Mr. Ahuja, for speaking to Bloomberg Quint. First of all, net profit adjusted for the investment that you made during the quarter has grown 62%. And at the same time, net interest margin has grown by 40 basis points to 3.4%. Can you broadly, very quickly take us through how that was achieved?
Okay, so combination of volume growth, business growth. So there's a 44% growth in advances, and there has been an improvement in margin. So therefore, as far as the effect of both volume and margin effect is concerned, net income has grown at a higher rate.
Okay.
Why did margins go up? Well, 2 or 3 reasons. One is that compared to the past, our cost of funds has come down faster than the reduction in yields. Our asset mix has moved in favor of the higher yielding businesses, which are largely the retail and the financial inclusion business. So while both have grown, these have grown faster. So they're having a proportionately greater effect. Yeah, and CASA has improved.
Yes, and a quick question on the advances that you said grew 44% for the half year.
Yes.
But in this quarter compared with the last quarter, they've grown about 12%. So can you give us a quick breakup of where that growth has come?
Yeah, so again, 12% on an annualized basis is of course more than 40%. And but having said that, the growth has been both on the wholesale side and on the retail side. The wholesale book, on the average, is growing between 35 and 40% per annum. The retail and financial inclusion book is growing at between 40 and 45 to even 50% in some cases. So that's how the...
So for the full year, your target is to achieve 30 to 35% CAGR.
We may do better.
The cost of credit has gone to 89 basis points. Is it likely to stay at around that level or
it'll come down?
Okay, and what is the rationale for that?
So part of the higher credit cost is the extra provisioning that we have taken. Okay. At the same time, it's a reflection of how the portfolio. We've done certain. I mean, while the portfolio is stable, I think in some cases, particularly in our SME portfolio, where there was relatively higher stress, we have basically done some tight provisioning, and we have also cleaned up that portfolio, and the way it is panning out is that today the sequential slippages are lesser and lesser.
Got it.
So if you see, gross NPA first quarter end was 1.13, second quarter end 1.11, 1.10, and going down.
My very last question for you, sir, is that a cost to income ratio has come down. We're in a declining interest rate scenario. Your target is to bring it to around 50%, if I'm not mistaken.
In a 3-4 year period.
In a 3-4 year period,
yeah.
So is it likely to happen much earlier than anticipated?
So let's see how that goes. But having said that, we are continuing to invest. Yeah. So and therefore our investment program, which is in branches, people, process, technology, brand, distribution, all of that technology, all of that is continuing. So I would say that the improvements will happen from year to year, but whether we will fast forward those improvements, I would not go to that extent.
Thank you so much for speaking to Bloomberg.
Thanks. Thank you.